suggest we start because the participants.
I think there are some problems.
Okay, thank you very much.
Yeah.
Now we are ready to start. So first of all, thanks to all the participants who joined us today. As you see, we have over 100 participants now, and maybe later on they will join some more. So at the beginning, I would like to ask everybody to switch off their microphones, to mute themselves, and to switch off their cameras now or after the presentation part starts for a better connection. We are very thankful that Allianz Bulgaria is organizing this webinar today with the German-Bulgarian Chamber. And first, I will give the word to Ms. Carmen Struk. She's the Deputy CEO of the Chamber, and she will say a couple of words to open the webinar.
Yes, good morning, dear ladies and gentlemen. Good morning from Berlin to Sofia. It's a nice constellation, I think. Yeah, welcome, and a big thank you to Allianz Bulgaria, who came up with this up-to-date topic, Emerging Europe. A lot of countries are facing the second lockdown right now. For this year, already in 1 year, 2 lockdowns. And this has a traumatic impact on its economy worldwide. So companies actually in different branches facing not only insolvency, but really hard pressures and yeah, really struggling through this year and probably for the next couple of years for recovery. And this is really hard for their perspective actually and for their motivations. Yeah, before I wanted to start, Lubasha already introduced me. I'm Carmen Struk, the Deputy CEO of the German-Bulgarian Chamber of Industry and Commerce. And I'm really thank you, as I would said already, to Allianz that we get the chance in the end of the year to have an outlook also to 2021, and I'm really curious what that would look like. And Lubasha also introduced our rules for speaking, not speaking, and we have also a Q&A session afterwards, and we would like to use that is not going really, that is going in the right way. So use also the chat function if you would like to ask something, to put it in the chat, and then we will point your name, and then you can ask directly and get into the conversation so that we get much more in a dialogue than a monologue. Yeah, right now, also we would like to reflect now on the COVID impact on Eastern Europe policies and the outlook for its economy. So please, Mr. Sianos, he is the CEO of the Allianz Bulgaria, for your introduction words. Please, it's your floor.
Thank you, Carmen. Good morning, everyone. We're always delighted to contribute to the series of engaging events organized by the German-Bulgarian Chamber of Industry and Commerce. These events help us share ideas and give us the opportunity to benefit from the insights of great speakers from leading organizations. Allow me a few words of introduction for our speaker today. Ludovic Subran is the chief economist of Allianz SE and our group's credit insurer Euler Hermes. If we just consider the geographic scope and size of our group's businesses, be it in terms of assets under management or credit limits granted, the breadth of topics that Ludovic and his colleagues must cover becomes evident. The economic research at Allianz SE and Euler Hermes is a unique team that bridges top-notch research on countries, sectors, capital markets, and trends to provide clients with best-in-class knowledge. Prior to joining the private sector, Ludovic worked for institutions such as the World Bank and the United Nations World Food Programme. Ludovic teaches economics at HEC, École des Hautes Études Commerciales de Paris, and Sciences Po, Institut d'Études Politiques de Paris. Young global leader of the World Economic Forum, ranked by the Choiseul Institute and Le Figaro as one of the 100 French leaders of tomorrow. Foreign trade advisor, Ludovic also sits on several boards of directors and advisory boards. He has contributed to numerous books: La femme et le marché, Hunger and the Markets, 2006, Désordre dans les monnaies, Currency Disorder, 2015, and Je comprends enfin l'économie, I finally understand economics, 2020. Ludovic is a graduate of the École nationale de la statistique et de l'administration économique and of Sciences Po. You can follow Mr. Subran's analysis and forecasts on economic issues by subscribing to his weekly newsletter, Ludonomics, or directly from the Allianz Bulgaria LinkedIn page. Overall, the research produced by the Allianz Group enjoys a broad audience, also in Bulgaria. Economic issues, social problems, and questions of economic policy are all areas where our experts strive to provide fact-based perspective. In focus today are economics of emerging Europe and global economic trends, particularly with respect to COVID-19. A recent study of Euler Hermes reflects also the introductory remarks made by Carmen. Economic activity in the emerging Europe region rebounded markedly in Q3 2020, but new lockdowns will send the region into a double-dip recession in Q4. The short-term economic cost of these second lockdowns is expected to represent 30 to 50% of the economic impact that the region experienced in March through May. As a result, the full year 2020 GDP decline will be to the order of -5%. Ludovic's presentation will elaborate on this and other themes that drive future development.
Thank you so much, Yanis. So it's a pleasure to be here. It's unfortunate that I cannot be in Sofia, a city that I like very much. It's a broad topic. So what I suggest I will do is that I will give 20 minutes, 30 minutes of an introductory presentation about our Outlook 2021, and then please let's have a conversation. I think that's the most important. I try to put in some data about Central Europe. I try to put in some data on sectors because I know the chambers of commerce, you guys are in the real economy. But anything, just give your questions in the chat function, and I guess then there will be a moderation also of the questions. I mean, just take the floor. So let me just share my screen. I prepared a few slides. Okay, so looking into 2021, the big issue is the one of sequencing. So as you can imagine, vaccine economics after quarantine economics is actually something about the risks of transitions. What I mean by this is, great, we have a vaccine, wow, let's rejoice. But, when you look at how the financial markets have reacted, this is not a good indication of how the real economy will react. This year, 2020, we've seen indeed these two series of lockdowns. We've seen the choices by policymakers to be very profligate, very supportive of businesses. Through partial unemployment schemes. In Europe only, we have close to 30 million people that are benefiting from some form of partial unemployment with guaranteed loans, many liquidity bridging measures. So businesses have been a bit at the center of the response. We've also seen monetary policy being very accommodative to avoid any type of financial crisis. We've seen, so many decisions that have been taken in a rush. Yet, when we look into 2021, the big question is, how do you unplug all of that? How do you unplug emergency support and transform it into something more sustainable? How do you reassess political risk with a COVID-19 backdrop? Something as simple as the German elections, but something as complex as the EU debt mechanism that was put in place, Next Generation EU. How do you think about globalization after a record low trade momentum in 2020? How do you restart the economy? And how do you do that with something as uncertain as a vaccine? Uncertain because, okay, we have a vaccine, but there is a world between having a vaccine and vaccinating people. There is a world of execution risk. There is a world of trust to be built with citizens and politicians, or to rebuild. There is also a world of activities and behaviors to restart. Just imagine, events management, hospitality, tourism, restaurants, hotels. All of these sectors are actually should rebound, thinking about airline transportation, but are in a very difficult situation, which is how do you rebound? Because this is something that we have not seen in the past 100 years. And I think this is why, looking at the real economy will be actually very interesting, but also very complex in 2021 because of this risk of sequencing or mis-sequencing that will actually leave the room for a lot of volatility, a lot of negative surprises, possibly a lot of positive surprises too. But we're in for a very tough ride, very rough ride in 2021 because it is not easy and it's never been done. So sometimes I feel that we went from doom and gloom to it's a miracle. Sometimes I feel that people actually are even too pessimistic, saying, okay, we will never restart and we're going to have a very bad financial crisis. I think it is really something in the middle. But what is very important is to look in the right direction. And the right directions are indeed fiscal and monetary support, health policies and decisions, but also, I would say how this will be handled when it comes to businesses that have benefited from the situation. A lot of businesses have accrued a lot of cash. We have, we will certainly go for a very strong M&A wave. Some sectors may actually benefit from the reshoring support from the European Union. And on the other hand, you have a looming insolvency wave, which shows how Darwinian, how this crisis has actually revealed the differences, very strong differences between businesses, business strategies, sectors, and countries. So, I talked already about the execution risk of the vaccine. For me, it is really the biggest issue. I've spent part of my life in the development economics world. I've managed vaccination campaigns, with the World Bank. This is not something easy to do. Because of the shortage of health professionals, because of the reactions to vaccines by the public opinion, but also because, as you can see, the vaccine is supposed to be a big reconverger. In the mind of an economist like me, I'm thinking, okay, the vaccine would be like a switch on and off button. When you have the vaccine, it means we don't see so many differences between countries because the vaccine is supposed to be a public global good. That doesn't work this way. You've seen already the ups and downs of the pre-orders. You've seen also some of the decisions that were made between the vaccines. But what is very interesting is the fact that, for example, emerging markets, especially I would say Latin America, South Asia, and to some extent Southeast Asia, where you have the bulk of people, maybe not at-risk people, and this is one of the issue, I guess. There are very few pre-orders for these countries. And so this is going to be maybe a rebirth of the developed world, but we haven't found yet a solution for financing the vaccine for the entire world. And this is important. Why? This is important for global trade, especially global trade and passenger freight, tourism. For a country like Africa, just imagine, you have to restart, for a continent like Africa, you have to restart growth without China, because China is looking inward, without tourism, because nobody wants to go there because you don't trust the hospitals, and without commodity prices rebound. This is a very tough economic situation for some countries, for some continents. So that's something we need to keep in mind. There are still some loopholes when it comes to how the vaccines could actually be efficient, especially when you look at how much it requires to reach herd immunity. We have, I will send this presentation, Yanis has it, so we can go into some of these details with you, but this is very interesting to see that these assumptions actually make a lot of the economic assumptions for you as businesses, for budgeting. You have to, after being a specialist on epidemiology, you now have to be a specialist on vaccination to make sure that you gauge how your turnover growth or your profit growth could actually be impacted in 2020. So the big issue, and how does this translate, this vaccine complexity into economics? It's all about confidence. It's all about, social expenditures, how much, if we look back at 2020, something that we didn't hear much, but which I think is massive to explain to people. This was a service crisis. This was not, a classic manufacturing or commodity crisis. It was all about, forced and precautionary savings. So the crisis really is in hospitality, transport, footwear and clothing, so textile, equipment goods for the household, culture. The crisis is really into a series of sectors that are these, social expenditure or sensitive consumption, as we call it, of the total basket of goods and services that the household consumes. And this is something that is new, because this is something that, for example, policymakers don't really know what to do. What do you do in that case? Do you give a voucher to people so that they book their holidays the next summer? Do you give them, cash so that they go twice to the hairdresser? You don't do that. That doesn't make any sense. And so the restart is the same. The restart is, how do you make sure that people tap into their savings? How do you make sure that they consume? And this is something that we know a bit more of in the economic literature. It's about prospects, jobs prospects. And as you know, unemployment is actually on the rise in most countries. Some zombie jobs, that were people that were kept in partial unemployment, will actually not find a job. Those people that are not even looking for a job because in their sector, the prospects are not good. And those people who basically lost a job because their companies is not there anymore. And this is something that is, of course, putting a lot of weight on the recovery in 2021. The second thing is social protection. We know that, the stronger and the more transparent and the more the easiest to understand, the simplest social protection system are often good for consumption decisions. And, in my country, France, for example, right now, in the middle of the COVID-19 restart, we have this discussion about reforming pension. And it happens so that I understand that you guys have the same discussion in Bulgaria because of, the decisions that have been made on the pension and the social protection reform. This is not good for consumption, because this is something that actually makes people want to save more, this so-called precautionary savings, instead of with very low returns, as you know, in most of the cases, with very little possibilities or options to restart the economy without the consumption component. So it is going to be all about trust building, forward visibility building, new solutions to transition from emergency fiscal measures to more supportive one. But it's also going to be about the other policy environment that has been a bit put on the back burner in 2020, which comes back very strongly to us in 2021. Innovation, competitiveness, structural reforms, all of those things are very important to make sure that we have a true rebound in 2021. On the financial markets, you've seen this year, incredible year. I think it's once in every 20 or 30 years that you can make so much money on the equity market, to be fair. So it's of course something that is completely crazy, especially on the US equity market. I have been personally very surprised by the tech bubble. I continue to call it a tech bubble, and I'm sure it's a bubble when you look at our models, return rates. So expected return rates for Tesla, for example, is 485%. How do you think this is something that is linked to any fundamentals? Okay, Elon Musk is very smart, he's doing great things, but 485% of expected returns, this is bollocks, And so for us, when we look at the equity at the financial markets, we saw three things in 2020. We saw the very strong anchoring by monetary policy of ultra low interest rates for years to come. Certainly the first time that the Fed will hike will be 2023. So the ECB will certainly hike after that, if they hike in the next 5 years. We see new people coming to the market, so new positions, especially coming from retail. So, private investors, people that want to have a complementary income. And we also see that we have this entropy So this concentration of gains that are very, there is again this Darwinism, if you will, in financial markets, where you have, U.S. equity very strongly rebounding compared to European equity, for example. You have price for safe assets that have this, cautious stance, and in the meantime, you have gold that has actually appreciated very strongly. You have, these corporate bonds that have been record low, including high yield, which is something that is not, that doesn't smell good when you look at indebtedness, net gearing of companies, when you look at prospects in some sectors, when you look at issuance in Europe, for example, of high yield, or mostly in the oil and gas sector. Just imagine the type of regulatory shock the oil and gas sector is going through in the next 10 years. You also have telecom. Just look at the consolidation needs in the telecom sector. You have retail. Just look at how retail has been completely accelerated in its digitalization. That's the positive story the McKinsey will tell you. But in reality, how many retail shops are going to close just because they didn't make their transformation into something that, was a good combination of brick and mortar and online sales? So financial markets are capturing part of the story. They're capturing the idea that, somehow the COVID is just a secluded, circumscribed crisis. What they're not capturing is the fact that COVID is very complex when you look at the coping mechanisms put in place by company at the company side. Something else I wanted to say on financial markets is that the exuberance of financial markets is causing long-term scaring effect, especially on savings and retirement and investment solutions. I'll give you an example. If you're young people, you're 25, you're getting out of university, you're going to have a tough time finding a job. This scaring effect on your real wage when you are 40 is 10 to 15%. So that means you make 10 to 15% less if you didn't have a good school to job transition, if you're a young person, compared to the guy that actually exited in 2019. So recession means no employment. No employment after school means you may actually have a lower wage when you are, 10 years or 20 years into the job. But what these numbers on the financial market means is that if you actually save a little bit for your retirement, if you can, because asset prices are very high, look at mortgages, look at real estate prices, look at the how much a stock is and the entry cost for a lot of young people to actually get their first stock. But what is more interesting is that you're going to have to put aside, so to actively save 3 times as much as someone from 10 years or 15 years ago to get a similar retirement income because of the exceptionally low interest rates that are going to be there to stay. So that tells you a little bit also some of the legacy effects of COVID on generational cash, the legacy effect of COVID on how people will look back at this crisis and think, wait a minute, did policymakers just save the financial markets, or did they save the real economy, the economy where you have people that are looking for jobs and companies that are looking for clients, right? And this, for me, is going to be a very politicized debate over the next 5 years that we need to keep in mind, because people will remember that in 2020, the world have contracted by 5-6%, but financial assets of households have actually appreciated by 6%. So that's something that is going to be, of course, of great learning, but that's certainly caused even more of these insider perception issues. Trade, this is a very strong sector for Bulgaria. Trade has collapsed massively in 2020. The rebound is better than in 2008, 2009, but it's mostly in goods. So we have a manufacturing rebound that is much stronger. Trade in services, of course, a lot of that is travel and transport services, is of course completely, depressed. When you look at most of the estimates, and including our own, I would say air transportation sector will go back to pre-crisis level only by 2024. But I would say also the export of services, so non-financial services, legal services, cross-border services, including financial services, banking and insurance, have also been very depressed. There is a home bias. that has been very strong in services. And of course, decisions to invest, and we will look in the numbers for a country like Bulgaria, that does mean that foreign direct investments have dropped. So this is, I think, where the big issue is when you look at the external sector. This is why most countries need to do even more efforts on competitiveness, on attractiveness, because it's going to be a tough game. It's going to be a bit of the Hunger Game out there between countries. A lot of countries are pushing for reshoring. In Europe, we have this big plan for sovereignty and reshoring. We just did a survey to 5,000 businesses, and we asked them, are you intentionally willing to reshore? And less than 1 in 10 companies have actually talked about reshoring. Why is that? Because you cannot defy gravity. Most of these companies that have decided to locate their production in site A or B is because they found the skills, they found the fiscal incentive, they found the market. And for us, we don't see a major move for reshoring. But if there is one, Central and Eastern Europe should actually play that card massively. So whatever can be done in the business climate for Bulgaria, but the others are doing the same, is going to be essential to capture a bit of the reshoring of the European supply chains in 2021. And this is going to be a bit of the crumbs that people need to get, because I just give you a number. In 2020, the total share of Chinese imports in global imports went from being 17% to 26%. So China has leapt forward massively because they were first in, first out, because they had plenty of stocks, and because when you play at the game of supporting the economy centrally, China is just better than everybody else. So it's going to be, a bit more of it's going to be a tougher game when it comes to trade. It's going to be a tougher game when it comes to location of IT services, call centers, something also that Bulgaria has been looking into for quite some time. But this is something that we need to keep in mind, and this is a little bit the role of these business organizations to continue to advocate for the right business environment, for location of business, and for competitiveness. I talked already about monetary policy. What else can I tell you? This is, the ECB has certainly played a major role this time around, playing in the Bundesliga, in the Premier League, compared to the past time. This is going to be very difficult to unplug some of these accommodative stance, and we're going to have to handle the secondary effects, the side effects of this monetary policy, of course, on savings and returns, but also on the banking sector in Europe, which is basically under life support. And to a certain extent also on currencies, which is something that, of course, for Bulgaria and the access to the euro is something we're going to have to keep in mind. You see the euro has appreciated strongly against the dollar. This is, of course, linked to whatever growth differential, whatever accommodative stance the ECB has been doing compared to the USD. But also there is something maybe more to it, which is, can the euro be one of these international currency? The euro has played this card during this crisis, which I think is very good. We've decided to save the euro at any cost compared to last time, where we basically let down the Italy, Portugal, Ireland, a bit too fast. But in the long term, that means we really need to play that game much more than we've done in the past, understanding other factors that play a role in monetary policy, maybe jobs, just like the Fed, maybe macro prudential and macro stability, just to handle, the problem of the banking sector in some countries in Europe, but also, trying to see how political we want to be with our currency in a world where the renminbi and the dollar have become much more political. Trump decided to stop the strong dollar policy. The renminbi has appreciated massively to protect capital outflow from China. We are a bit, the best, student of the class, great, but, currency wars are going to be one of the major consequences of this ultra loose monetary policy everywhere. So we're going to see a lot of upheavals in the currency world. And this is something that when you manage a consolidated account and when you trade internationally, I would really advise to look out for currency swings in 2021. I talked about budgetary support. This is a big issue. You know, every country is doing something different. The big issue of 2021 is going to be to really find a way to reassure on the deficit and debt trajectory without passing any austerity measures. And most countries are decided to avoid any early tax increases, but at the same time to transition, to unplug some of the emergency support, to make it a little bit more, you know, yielding in terms of return on investment. You know, so greening the economy, reindustrialization, human capital investment, innovation and education investment, all of that are going to be part of the toolbox of countries. But for that, they're going to have to stop giving some of these handouts to some sectors and some actors of the economy, because we were very bad at targeting and we were very bad at managing the windfall effects of this, you know, blanket support to several sectors of the economy. And this is one of the issue. One of the reasons why the governments have very strongly supported the activity is because they wanted to avoid at all costs an insolvency wave, and they managed to do it. Actually, when you look at 2020, we have a record low number of insolvencies in Europe. You know, it's a drop by 17%. In France, it's a drop by 56%. In Germany, by 34%. This is stupid. Huh? That tells you how we don't know much about what's happening under the hood of most businesses, because some of them have been kept alive without really having a business model anymore. This is not the case in Central and Eastern Europe. There's been an increase in insolvencies in Central and Eastern Europe by 7%. But compared to the severity of the crisis, you know, when you look at the numbers in Poland, in Czechia, in Slovakia, you know, the numbers don't make sense in terms of, you know, how many insolvencies we should see with this type of contraction of output. So that's why we expect that, you know, in 2021, we're going to see a first release of these companies once the government unplug or start to unplug the support. So payment risk, especially, you know, B2B payment risk, so working capital, which is really what CFOs spend most of their time, is going to be an issue in 2021. I don't think it's going to be like massive like in 2009, because we have good access to finance to the markets and to banks, but we're going to have a long tail risk of credit risk into 2022. So we've seen, for example, that a lot of companies have been asking their suppliers for longer payment terms. So the average DSO and the day sales outstanding has increased by at least 2 weeks since the beginning of the year. And we expect it to in total increase by 3 weeks by the end of this year. And so that does make a difference here, right? If you have almost a month more of payment terms on average, because in some sectors like IT services, like construction, you know, it's already twice what it is on average, you know. So if it's 70 days, you know, you already at 140 days. And if you add, you know, 3 weeks, you are what, at 160 days. It's a lot, you know, and it does drain a little bit the liquidity at the company level. And so that's something we want to continue to alert on in 2021. So in terms of sectors, you know, this is what I graphed here is by when sectors should return to pre-crisis level. So you have sectors like food retail, pharma, agri-food processing. You haven't seen really the difference. You have other sectors like, you know, beverages, chemicals, machinery, construction. Actually, you should go back to pre-crisis level quite easily. Then you have those sectors that are related to the consumer that take a little bit more time. So electronics, transportation, then, you know, the other transportation, especially by sea and road, hotels and restaurants, only H1 2022, and so on and so forth. And then you have those that are a bit more in difficulty, like transport equipment, non-food retail, especially specialized retail, clothing, garments, etc., air transportation. This is going to be the tough ones. So if I go, maybe I have a few zooms on some of these sectors at the end, if you want, especially when it comes to retail or automotive, which are important for Bulgaria. We can have a conversation on that. Just these are the numbers just for you. Just a few words on emerging Europe and Bulgaria that I find interesting. I talked to you about this attractiveness conundrum. This is gonna be the major issue of 2021 for the Central European countries, is how much investment decisions can you relocate to your country? Because of the reshoring, because you're better than the others, because the economy is restarting, because you were efficiently specialized, because your people are good, because your policymakers are not making too many stupid things. This is going to be a major issue for the region, because a lot of the countries of the regions have lost a lot of their attractiveness. Some of them because of structural problems, like Romania, which has been overheating for quite some time, wages going far too high. Some of them, like Hungary, have actually managed to weather the crisis when you look at some of the decisions that were made by politicians. So it's not a zero-sum game, but somehow this should be a major policy objective for the countries of the region, on top of competitiveness, right? How competitive can you be? It's about how attractive can you be. And I think this is about productivity, this is about specialization, this is about building skill sets, because they're going to be important in healthcare, in manufacturing, in logistics infrastructure, in technology. This is going to be really what people are going to be looking at in 2021. And believe me, there is a lot of cash. Of course, there are going to be a lot of insolvencies, but you also have a lot of companies that are loaded with cash. And so if you have a good business case, you could attract cash, you could attract M&As, you could attract some location of production, some outsourcing. I guess home office has shown that people are worth more than the square meters they occupy, and so somehow it's going to make a lot of people ask again what type of reshoring what type of outsourcing they can do. So you have this reshoring in the manufacturing sector happening at the same time as another wave of outsourcing in the service sector. Here you have a little bit the comparison between countries on fiscal. So Bulgaria has been compared to other countries a bit too cheap with support. I think Bulgaria could have done more. It was, it's a decision that was really about making sure that there wouldn't be some further consequences. But if you look at countries like Slovakia, like Hungary, like Romania, Poland, Czechia, these countries have done a lot more than Bulgaria to help, especially businesses. And so the question will be about what is the financial situation of a lot of companies at the end of the year, and whether the Bulgarian companies can actually compete with companies that have been getting a lot of guaranteed loans, for example, from the rest of in the rest of Central and Eastern Europe. And this is a major difference, I would say, between Bulgaria and the rest of the Central and Eastern European countries at this point. So there's been, I guess 6.7% of GDP announced as of September for Bulgaria. And the idea is that Bulgaria is playing I'm the best in class type of, especially when it comes to indebtedness, because of the access to the euro, because also of the party that is currently in power. But this is going to be quite interesting because, is it too good or too honest to be true? And are the others not mechanically doing some form of social and fiscal dumping? If I look at Western Europe, there is a bit of a game at play between countries that are hiding subsidies behind, the recovery plans. And so I think that's going to be something very strong also in Central Europe, between countries that have done obviously more, like Czechia, but also countries that are announcing little, but that are doing much more behind the curtains, just to make sure that they attract these new projects, or they show, or they subsidize salaries, for example, which, everybody is doing it in spite of it contravening the European basic rules of competition. And this is something that we're going to have to live with at least in 2021 and 22, and to navigate for businesses going forward. So we have a forecast for Bulgaria of minus 4.6% in 2020. We have a rebound of 3.3%, back more or less to pre-crisis level by the end of 2021. So most of Central and Eastern Europe is actually rebounding much faster than Western Europe. We have, on the insolvency side, because I mentioned that before, so the numbers of insolvencies in Bulgaria are quite low overall. But if you just look at this, number of cases, you see that we had only a 6% increase this year compared to, the strongest recession since, I guess, 2008, 2009, or maybe since the banking crisis that followed. But we continue to expect an increase to almost 670 insolvencies in 2021 and above 700 in 2022. So tighten your seatbelt when it comes to the, I would say, risk of non-payment from your customers in 2021 and 22. As I said before, and I don't know if you guys care about that, maybe you think it's but for me, people, don't talk enough about this, but the access to euro and COVID is an issue. And so for me, because everybody is giving special treatment, but what happens to countries like Bulgaria that have been really abiding by the rules for quite some time, or trying to, because there was a bit of overheating in 2008, 2019 for inflation. The overheating has been everywhere. I mentioned the massive overheating of Romania and Hungary, but in Bulgaria, there's been a little bit of overheating when you look at inflation in 2018, 2019. So what I want to say here is that in spite of COVID being exceptional and extraordinary, but maybe because of the euro, Bulgaria has done little, right? Especially on fiscal profligacy. But that does mean that the big issue when I mentioned currency is for Bulgaria to continue to have the peg from the lev to maintain this in spite of potential social risks stemming from this crisis and for purchasing power of people, for competitiveness, etc. So this is going to be, of course, I have no doubt this will happen, but this is something that, as I said before, is going to be a very political decision to maintain. So for me, there is no risk of depegging, but it's going to be something that politicians will have to explain and to carefully manage in the next year or so, couple of years, just to make sure that this is a walk in the park and that Bulgaria can actually meet all of the criteria by the required and allotted time. Well, I mentioned you have 2020, you have just a tiny excess of deficit. Of course, I mentioned the banking crisis because for me, 2014 was, the Greek-Bulgarian situation was, of course, of much concern for me at that moment, already working for the Allianz Group. And yeah, we have this 2025 deadline. I don't know what you guys think about this, but it's interesting to see that I guess there is also a push from the institutions. Bulgaria joined the European Banking Union, the law on the BNB, which has been quite, I would say, controversial. These are good signs, and I think this is something that is very reassuring. And if you're a business in Bulgaria today, you have this planning that is very strong and that has been quite successful so far, in spite of once-in-a-century type of crisis, which I think really means that there is when I talked about the reputation and the equity, the brand equity of a country, in Central and Eastern Europe, Bulgaria has a bit of an edge compared to, and I just mentioned two of them, compared to countries like Hungary and Romania, which have been quite surprisingly volatile or erratic over the past 5 years when it comes to decisions on the business environment. Actually, it started even before. In 2014, there was this forced transition from euro to forint in Hungary that actually settled a lot of businesses operating there, and that actually meant for Australian, you know, as you may know, the banking sector in Hungary is owned by Austrian banks up to 80%. So that had quite an issue, or that was quite an issue at that time on the cross-border banking extension between the Eurozone, Austria, and Eastern Europe. So here I have, you know, a few points on you know, agri-food, where, you know, I told you it was going well. You know, the big issue in agri-food is that we expect commodity prices to be low because of La Nina. I think it's something that is also quite important for Bulgaria. We continue to believe that it is a major sector. It has proven very resilient. There is still a lot to do. Beverages were a bit down in 2020 compared to the rest of the sector, but it's still a very strong sector. So you have, you know, some in Croatia, for example, you have this major actor, Agrokor, which was quite an issue for quite some time. It represents 15% of GDP, by the way. So this could be an ugly story, but most of the time it's a very, very good story with, you know, downward pressures on the distribution side, but an overall very healthy sector. On the other end of the spectrum, you have transportation, right? So transportation equipment, you know, we had already some bankruptcies in air transportation, in road transportation. So these are, you know, and for, you know, for Central Europe and Eastern Europe, you know, Poland, it's a big issue. This is one of the major problem of that sectoral problem that Poland will be faced to. Along with retail, actually, and retail, I talked about it enough, you know, for this presentation. So maybe I will stop here, and then, you know, we can have a conversation on the countries, on, you know, whatever, on sectors, anything that you find useful. And I thank you very much. The good news about, you know, saying thank you in Bulgarian is merci. So this is a word I know. So thank you very much, everybody. Merci, and then I wait your questions and questions to my statements. Thank you.
Thank you very much for this great presentation. Now I see that there is a question in the chat, or two.
There are two.
Yeah. So
do you want me to read them?
Or
do you want me to...
Yeah, so I will read them, and then you can
okay.
ask.
Okay.
It is a real privilege to attend your presentation. At the beginning, you mentioned that decisions in the world are being taken in a rush, bouncing from doom and gloom to miracle. Which risk is higher, that of a fiscal stimulus that is set too short, or the risk of losing faith in market economy mechanism?
I think the risk of losing faith in market economy is something that has started before, and that has been magnified by this crisis for good things, you know, such as COVID has reminded us of the existence of probabilistic, exponential, systemic risks, like climate could be one. So I think this is good that we reinvent or we rethink what this risk could be or could mean. So I guess there is, you know, a stronger commitment to ESG, and this is not necessarily compatible not with market economy, but with what we did with market economy, especially the institutions, the rules, you know, that replace trust, the role of central banks. I mentioned that, you know, we have this pseudo belief that central banks are independent when they are actually very strongly, you know, not dependent. And, you know, I remember we met with Yanis during the peak of the Greek crisis, and, you know, I was always shocked that the ECB was sitting on the opposite side of the table. You know, when I was working at the World Bank and the IMF, you know, when we would negotiate a bailout package with the country, the governor of the central bank and the minister of finance were sitting across the side for us. And only in Europe we have the ECB on the wrong side of the table that made this whole adjustment trajectory so painful for so many people. So there's been already discussion. Then COVID, what COVID did is that COVID gave the impression that the government can do everything. There was a role for the government. I think health is a public good. Maybe we shouldn't have deregulated health that much. Look at the situation in the UK and the US. It's a nightmare, right? So the COVID has revealed that, and so the government took back some power. The problem is governments, especially politicians, think they have the superhero syndrome. So when they start putting a bit of help, they think they can run everything. So what we see as a major risk now is this idea that governments wants to be in every single sector. They want in France, the Minister of Finance yesterday was on TV saying insurers have to pay because they were not as affected as the other sectors by the crisis. So please give them 1.2 billion euros by the end of the year. We have, governments in Germany, in Belgium, in France, in Italy that are taking shares of companies because they're not doing well. So you have this risk that governments are over-welcoming their stay. And the question is, how do you transition out? So how do governments actually go back to their place, so that the genie doesn't get too out of the bottle? So so this is a risk that has always been there. This is a risk that has been exacerbated by people like Trump and Bolsonaro, who are very strong interventionists, much more than China. But this is a risk of all of us, the business community, the citizens, the voters, to continue to monitor, to avoid that we go to a state capitalism system like China, and to avoid that we go to rent seeking, to avoid that we go to a system where government is stretched too thin, and we have major issues, and we've seen that in the past. Right now, there is, a lot of discussion on where government should be as a safety net, but where the private sector should be and operating in full transparency of prices, for example. So this risk is there, but not as much. The risk of the fiscal is a real risk because this is a cyclical policy. So the risk of fiscal is you should be able to continue to help, but to go from not so quality, but very good for social risk spending to better quality spending. You should be able to reassure on the trajectory of your deficit without having to front load the increase of taxes. You should be able to explain what you're trying to achieve with your fiscal deficit and not hide subsidies. And this is a major issue because you need to be a strong politician. You need to be a strong economist, financial, public finances specialist. You need to make sure that what you're doing doesn't create more damage than not doing anything. I mentioned that, in Europe, we have so many governments right now that are helping companies that don't need, yesterday, I'm not going to give you the name of the friend. Yesterday, I had lunch with a friend of mine. She's the CEO of major healthcare equipment companies. And I told her, oh, how was the year, She was like, oh, it was okay. I said, yeah, give me your numbers. She said, well, I did -8 for turnover. I was like, oh, that's not so bad, compared to the situation. She said, yeah, the team was really great. The first thing she would have told me would be, profits. And she didn't say anything. I said, how about profits? And then she smiled, I said, come on, plus 40%, 40. She said, we're embarrassed. I said, why? She said, because we got so much help by the government. We got all of these guaranteed loans. We got all of these liquidity measures. So we took them because, we were entitled to them. And now we're going to do this big acquisition in the US. We're going to do -8 turnover plus 40% profit. Can you imagine how distorted the world is? Because we were not able to target the stimulus to those companies that really needed it. Those that were smarter were the ones that actually took the cash the first. And then now we have the situation of super cash-rich companies and other companies that are just on life support. So you continue to give them cash, but they haven't even done any innovation. How many restaurants do we see in Germany that have not really gone online, that have not really decided to do some kind of delivery stuff. I was in the US for a month, I just came back last week. In the US, every restaurant, even I'm sorry, Yanis, I ate at a Greek restaurant in Minneapolis. The Greek restaurant in Minneapolis, they have takeaway. They do souvlaki takeaway. We are in the middle of the US, because they knew that they couldn't open the restaurants, right? We don't see the same type of push here because in the US, let so many businesses die. They let so many people go to the job market. It has a major social risk. Just look at the election and the shit it is. In Europe, we have a tendency to do, the creative destruction, which is, the normal process. In Europe, we have a tendency to do a bit of preserving destruction. So we keep things equal, but we don't really think about what comes next. And so that doesn't push enough businesses to innovation. So for me, that's the big issue of, this unplugging and the fiscal support is that you don't want to unplug too early because you don't want people in the streets because people are upset, but you don't want to continue to support stuff that should have disappeared. Maybe, in 2025, we won't have any more clothing stores in the street. Everybody's going to order textile online because, it's very hard to manage stocks and to have the size of the shoes, of the pants, of the, why do we keep them alive? They don't have a social utility per se, right? And this is the type of discussion that we never have, because, or at least that, in country we don't have because it's too complicated. In the transport sectors are very job intensive. So the fact that the transport sector is in such shock is very complicated for governments to manage because the railway system, nobody wants to touch on, what is happening in the railway, the airline, after they have the name of the country, so you want to help them first. These are the type of stuff that are, and this goes back to the other point by Nikolai, it's linked to the vision you have of a true market economy. But it's certainly a decision that governments have to do now because they have to do their budget 2021. If you look at budget deficits, in most countries in Europe, we're talking minus 15% of GDP.
Well, thank you. Your answer opened a great discussion in the chat. We have a lot of questions now, so I suggest we go on. The next one is, this is obvious that there is a disconnect between the financial markets and economy, or maybe at least between the financial market, the picture painted by the media. This question, wait a second, I moved on. The question is, who is right? You have mentioned the word bubble for the IT sector, and I agree that there are a few extreme examples. But apart from that, we have, one second, unprecedented monetary and fiscal support for the years to come. If I can use this cliche, there are too much money chasing too little assets. In addition, the PMI across the border are hovering between 55, 58 for the last couple of months, so the businesses managers doesn't seem to worry also. Don't you think that this justifies to some extent the recent good equity market performance?
Yes, I think Svetomir is right. A lot of people say, "Oh, the market is wrong." No, the market is certainly right in what they're pricing, and you're right. The market are pricing that COVID is a one-off, and so they see longer. And there is so much money. Where do you want to put the money? So, of course, I think the problem is what I said before is, one of the strong reasons behind the equity market performance is the abundance of money. One of the issue of the abundance of money is that it comes from liquidity injected by central banks. The problem is that this liquidity is not going to the company or to the people from the banking sector. So the problem is that one of the push factors behind the equity market is a political decision that is supposed to be, independent by central banks, but central banks are saving financial markets. And so that's going to be the big debate over the next 10 years is how really independent are central banks from financial markets. We know that the Fed, we done an analysis about that this year. we looked at the hidden agenda of the Fed because, why did the Fed in 2019 already decided to be so accommodative? They could have hiked a lot more because they're trying to suppress market volatility. There is a fear of market volatility. There is a need somehow to reassure market actors. And so this for me is the big issue, is that, yeah, my financial markets are certainly right on the fundamentals. The problem is the extra, the bubble making, or, the quite strong rebound, I would say, could also be linked to decisions taken by central banks that are there to save the liquidity, that should have acted to help restart the economy, but a lot of this liquidity is captured by financial markets because of the way it is set up. And I think that's what we're gonna have to deal with. It's just like, I believe financial markets are gonna be in very good shape in 2021. Again, I think the push factors are very strong. The problem is, as I said before, is that the role of the central banks to pump up the financial markets, or should they do something else? I don't have the answer. I have a conviction, which is there is something wrong here in how asymmetric the effect of central bank action is between the credit channel in the real economy and how much benefit you can see on the financial market. And I think this needs to be rebalanced, or we're going to have a major defiance towards action by central banks.
Thank you very much. Now we go on with the next question. Hello, Mr. Sabran. I have a question regarding inflation. During recent weeks, we saw inflation forwards creeping higher again. Do you think this is one-off phenomenon, or inflationary pressure is sustainable and shall we evident all 2021? Thank you.
So inflation is prices are accelerating a little bit in the food sector, in places where you always have a bit of friction, I would say, between supply and demand. I personally don't think we're gonna see a major rebound of inflation in the next years. I think we don't have strong collective bargaining, so there is no wage increase. Actually, wages are going to be very moderated. Most companies are going to say, oh, I didn't do a lot of turnover, so even if they did a lot of profit, they may actually not increase wages. I don't think we see, as I said before, a lot of velocity of money. So there is a lot of monetary injection, but the money doesn't circulate enough to create monetary inflation. And I think trade should rebound, and so have a deflationary effect, because you have so many countries that produce stuff that are so cheap, right? So I don't believe it could be a temporary overshoot, because growth is going to be 5-6% in the world. For some countries, it's going to be 10% in Europe. So there's going to be a temporary overshoot, but I don't believe this to stick. In spite of central bank being a bit, looking like they're behind, I don't think this is inflation that sticks. It's a bit of a one-off. There were decisions, for example, that were taken on VAT reduction in the UK and Germany. So I think we're going to see a bit of inflation fear. I don't see, or I don't, and market actors are pricing a bit this steepening of the curve, but I don't believe we're going to see a structural regime switch of inflation in the next year. That's.
Okay, thank you very much. Then we go on to the next question. Do you observe investors to come back to Europe, closing their production facilities in China after COVID-19? How do you evaluate the chance Bulgaria to attract some of those investors in the near future?
As I said before, when we did this survey, because we wanted to see what were the intentions to reshore, right? It was between 10 and 15% of companies that said, yeah, we're gonna seriously consider reshoring. It's peanuts. And after every crisis, you always have these politicians saying, oh, we are too dependent, we are too vulnerable, we accepted the principal component to go. It's politics, right? In the end, it's very hard to move the orchestra. You can move the pianist, you can move the soloist. It's very hard to move back the orchestra. It takes time, to make sure that you have everything to work. So there is certainly, especially in the service outsourcing, especially in pharma, especially pharma, chemicals, health in general. There is, but it's going to be tough. And believe me, China, just like the other countries in Southeast Asia, the Vietnams and the Indonesias and the Malaysia, they're not going to sit, and wait for us to be better at it. They're going to continue to cut prices, So we don't, yes, there is opportunity. There is always opportunity. But it's not, an easy game, because the others are going to do the same. Nobody wants to be left out of the trade rebound, and certainly not China. So in the, there are big industrial green manufacturing plant, hydrogen energy, drugs manufacturing, transport equipment, defense. There's going to be a lot of money from Europe on these sectors. But will it be enough to really reshore? I think in part, but not so much, because some of these decisions are about, it's not one company. You need to have the suppliers, you need to have the skills, it takes a bit of time. So yeah, and that's why at least the game is worth trying. And that's why I said competitiveness, attractiveness are key elements of policy ambitions for 2021, because even if it's peanuts, it's still something, and I think it would be stupid not to play that game. Just we need to understand that the game is not just waiting for the money. And the game is you need to really be better. So countries that have invested before in education, Bulgaria is one of them, in tertiary education, in apprenticeship, countries that already have a manufacturing base like Poland, etc. They would have a better ground for it, right? And as I said, countries that have stable policy environment also, because that's going to be quite important in the decisions to to offset some of the risks. For example, a lot of companies are looking at moving out of Turkey right now because of the the risks. Even though the lira is so competitive and so forth, people are concerned, and so stability will be a big play, because this is the reason why some businesses are leaving. Yeah.
Okay, thank you. Then we go to the topic of Green Deal. So the question is, the Green Deal faced challenges on the path from proposal to policy even before the COVID-19 pandemic took center stage. Some experts consider its goals not sufficient to stop climate change, while others don't believe that. World's economy is ready to sacrifice growth for sustainability. What is your opinion for the expected investments and developments in this area?
I'm a very strong believer in the Green Deal. I think I'm very proud that Europe decided to be a front runner in that. Biden is going to rejoin the Paris Accord, but the US has been missing in action clearly. So I think it's a vast opportunity for investment and investors. Nobody really knows what it looks like. So everybody, we, for example, as Allianz, committed to the net zero economy by saying we're going to be carbon neutral for our balance sheet in 2050, but we don't really know where to invest yet, because nobody really knows if hydrogen will pick up. Nobody really knows if utilities will disappear, So it's a world we need to define. What I know is that the ambition is good. The tools are crap. For example, as long as we don't have a carbon price, you don't give the right signal for businesses to transition their business. As long as we continue to talk about carbon tax without carbon price, as long as we have the taxonomy that says you're green, you're brown, you're good, you're bad, we're not doing the right thing. The right thing is to make sure that a company knows what type of sustainable path they could be on to comply with the regulation. Look at what we did to the automotive sector. We shoot ourselves in the foot. I don't have a car, and I'm not a big fan of cars, but the automotive sector is a major sector, and yes, we have, thermic cars in Europe, but the way we changed the regulation killed part of the ability of the automotive sector to innovate. Maybe they've done the wrong things. Maybe they spend a lot of money on having the fancy car, autonomous driving, intelligent car, parks itself, the good experience, the heated seats, and we should have spent a bit more time on the green engine. Okay, fine. But the fact that we changed the regulation made the future innovation and the transition to electric vehicles very complicated compared to China, for example, which actually gave a lot of subsidies to households by decreasing VAT, and that is now, has now adjusted for population, the largest green vehicle fleet. So I think let's stop regulating and let's give the incentives. Let's explain to businesses what it really means, what are the rules of the game, and then let them adjust. Don't try to tell them how to adjust, because this is how you cause major problems, right?
Thank you. Then a couple more questions left. So, do you think it's too early to talk about reflation in Europe? And do you see risk of a Japanese scenario for Europe in years to come, especially considering Europe's aging population?
So for reflation, yeah, I don't think there is a bit of reflation, which is natural with growth coming back. But I think the biggest risk right now is deflation. I wouldn't be surprised that we have yet another few months of negative price developments, because demand is so low. So there's going to be, as I said, I guess we're going to get by the end of 2021 around 1.6% of inflation, which is still below 2, but which is which is more than what we had, I would say, in the past 5 years, because we were below 1%. So there is a bit of reflection, but the big question is who absorbs the reflation? And I think it won't be the consumer. I think it's going to be the margins of the companies, because if there is a reflation, it starts with producer prices. So I'm sure that's why Pavlin is interested, that you may have to compress a bit your margin. I give you an example. The Chinese know that they are the only men in town. I have another friend who is the CEO of a manufacturing equipment good company. And he told me that his Chinese suppliers increase prices by 30%. It's take it or leave it, So that's reflation for you, because how do you want to do it if your sole supplier tells you, well, it's you take it or I found another one and it's 30% more than what you paid last year. So these are the risks, but they are secluded, right? The overall, as I said, we will see true reflation only when savings will be untapped, which is something that is going to be much slower than what we would think would happen. On the Japanification of Europe, we wrote a couple of papers on this. It's interesting because aging is the major equivalent. The big difference, I would say, is that, and of course the other equivalence is what we're doing on fiscal and monetary policy, which resembles Japan very strongly. We have a few stuff going on for us. Migration on the demographic side, which continues to actually help build a bit the able-bodied, so to avoid this complete inversion of the dependency ratios, even though it's a very heated and political debate in Europe. We also have good competition rules. Too good, some would say, but the fact that we have competition rules means that we don't have this domineering situation that Japanese companies have had in Japan for quite some time, that suddenly caused deflation to stick. We have a bit more competition in the telecom, in the transport, etc. And the last thing is, I believe that compared to Japan, we have a bit more heterogeneity in the zone. Japan was, not only because of competition and the concentration of wealth, but also because we have so many countries in Europe that you don't have all the country at the same pace at the same time. So that creates a bit of divergence, for good or for bad. But that certainly means that, for example, we have countries with excess savings, countries with current account deficit. We have countries that are very good at exports. We have countries that are very strong market outlets. So you hear the French, the Germany, the Italy, the Spain, the Belgium, the Netherlands, and I think this naturally makes it a bit more complicated to see this complete depression economics that we've seen in Japan for quite some time. But this is a major risk, and the question is, are we doing enough for that, especially on jobs? Japan has been much smarter, and we should continue to learn from Japan. Has been much smarter at boosting jobs, including by public work program. Japan has also worked on the insurance sector, because they had a major crisis, and helping, through the regulatory and supervisory role. So I'm not too concerned, but we should try to see what was good in their policy toolbox that we could apply in Europe to avoid the negative consequences of that, and especially the lack of investment and consumption. We are not there yet. But this is important for us to understand, as I said before, how the job market function in Europe, and how this could be an indicator of activity that we need to care for very strongly, instead of letting it slip and then having to restart it with public work program, which is really what Japan did under Abe in the past years, right?
Thank you. So we have 3 more questions. Do you see the dilemma between exhausted public spending and private liquidity as potential investors towards the need of higher capital on insurance market for financing upcoming higher claim demand? In other words, how insurance should attract capital while still avoiding pandemic covers, even already notified to exclude pandemics in their wordings?
I think this is very good. Again, this is a very good question. One of the issue for the insurance world is that this pandemic has revealed that we are too complex. The tiny prints in the contracts, nobody read them. How many times do you ask yourself if you're insured? Yeah, I remember, in France during, for a few years, the big stuff was, oh, you insured with your credit card. When you go skiing, you insured with your credit card. When you go, we don't really know what we're insured of. And that is what happened with business interruption insurance. And it's a very sad situation for everybody, for the clients, but also for the sectors, for the regulators and the supervisors. So I think we're going to have a regulatory backlash on this one. I'm pretty sure that the regulators and supervisors are going to go through a fine comb, because they finally understood that an insurance policy is different for every policyholder almost. So they're going to maybe, I hope that they don't have too much negative effect like they had on the banking sector with, the type of surveys you have to go through to get a loan or to get even open an account and so forth. But anyway, the big issue is these systems. First, and it's not because I work for Allianz, but you get indemnified for something you paid a premium for. This is the rule, right? You should never. And of course, the question is, how do you make sure that you know that you paid? I mean, pandemics were the gray rhinos. Everybody talked about it. You all had it in your top risk assessment, but nobody did anything on it, right? And this is the big issue with a lot of this systemic, exponential, probabilistic risks, right? So we're gonna have to find a way to do this. And even if, and this is the interesting point, I think, even if we find a way to insure, we're gonna have to talk about layering, because these type of risks touch the limit of insurability, because it's like cyber risk. These risks, they don't happen very often, so we don't know how to price them well. And when they happen, they have a series of consequences that are bigger than the balance sheet of an insurer. And so what is the public-private partnership that you need to make sure that you take a first layer and then the state take the second layer when it becomes too big to chew for you, right? So how do you, and you have to talk about that in calm times. You don't do that when you have a crisis, right? Which is what we're doing right now. We should have talked about that before, like natural catastrophes. Insurance is a very strong accelerator of rebuilding, of restarting, but only if we know that we are financially solid to do it. And so for me, this is, and we should talk about that, by the way, at the European level, instead of talking about that in every country that we're doing right now. We should really try to think, okay, what does a pandemic insurance look like? How do we want to help businesses, people restart their activity? Who takes the first loss? What is the stop loss? How do we articulate the payout function? This is a very important discussion to have. Of course, the last one we had was 100 years ago. So we never really had that discussion beforehand with authorities. Now we have to do it. I'm confident that the sector will find a solution. I'm confident that we're going to find an articulation of solutions between public and private sector solution. And I'm confident that we will be able to offer solutions to our clients as early as next year. We shouldn't let that one slip, because as we understand, these pandemic, or at least these epidemics, should happen a bit more often. And we see how catastrophic they are in terms of losses of income for businesses and people now.
Thank you very much. So the next question is, you are probably following PEPP development, Pan-European Personal Pension Product. How would you estimate the benefits and the risks related to that product?
So Allianz has been a big supporter of PEP, right? Because we believe that portability of benefits are very important, and we believe, as I said before, that the social protection should be thought, just like protection mechanisms in general, should be thought at the European level, right? So I continue to believe that this is a very important product, especially for the Europe of tomorrow, with maybe even more job mobility. And I continue to believe that we could do better at articulating the risk-taking of this product by the insurer in terms of liability management, because some countries are making it very tough for us to offer a product that is attractive when it comes to capital requirements, but also on the insured person, that they understand how this is just one layer of their retirement income. That it is not a magic bullet, So I think it is a very strong development, but generally, I would say that we need to continue to research and to propose solution in the retirement space, because this for me, we did the pension report. I think in Bulgaria it was quite a success. The people were very interested in it, and we call it the Gray Swan. I believe that retirement and pension is going to be a massive issue for, my generation. You have the care economy is stronger than your productive life. You have children and parents to take care of. This is a major, and, in Bulgaria, the society is, by the way, aging much faster. People are aging in good health most of the time, but, if you look at Central and Eastern Europe, because also of the past, the heritage of the Soviet time, you usually have the elderly in the household or very close to the household, much more than, in some Western civilization, like Western countries, right? And so this topic of how do you manage when you stop working to be able to cater to you, possibly to your mother, who is still living with you, to help your kids go to university, with the fact that price of education is, this is going to be a major issue. So for me, PEP is a wonderful development, but we need to continue to do more, and especially in this savings bottleneck and low yield environment. As I said before, if you have to save 3 times as much to get the same income as you needed to save beforehand, that does mean you're going to have to be very active with your saving solutions and investment and retirement management. And so that's a big area for growth, and a big area for new proposals, I would say. And again, here you see the role that the first pillar, so the public sector should or could play, but also I'm a big fan of a 401k in Europe. In the US, you have, these 401k pension schemes that are de-taxed and stuff. We should be bold and have something like that. In Germany, the pension crisis is major. I know this is the Bulgarian Chamber of Commerce. The pension crisis in Germany is major. Since the Hartz reform, complementary pension scheme have been mushrooming all around the Mittelstand in Germany. If you look today at these pension schemes, they are undercapitalized massively. And, no state will want to bail it out, but it poses a social risk. How do we explain to people that they should have made better pension decisions, And this is going to be a big issue. So I'm all in favor of PEP, but we need to continue the journey, because it's a long one.
Thank you very much. The next one is more of a comment than a question, so I'll just read it out. Thanks for the comprehensive and thought-provoking answer. What you said about government intervening miracles relates also to pension systems throughout Europe. One of the biggest challenges is to work for the establishment of a business favorable business environment for private pension management, business, especially in after COVID period when the government intervention in their inertia will remain. This was the comment. And afterwards we have the last question for now. How do you see the role of risk managers in the future? Finally, no one would like to insure pandemics on the classic way, and we would need more sophisticated ways to transfer risk.
You know, I mean, as you know, Allianz has a subsidiary which is called AGCNS, Allianz Global Corporate Specialty. AGCNS clients are risk managers. So I happen to spend quite a time with these animals, you know, because risk managers are very fun people. They, in spite of their job not being very fun. What I see happening in the risk management world is going to become more and more complex because captive management are going to make look at the future of risk management. After every crisis, and especially after this crisis, you know, risk managers come back to the front, get a bit more budget, get a bit more interest, get a bit more time in the boardroom. The question is that doesn't last because it's an uncomfortable discussion. It's the same discussion you have when you go to the doctor and he weighs you and he says, you should lose weight, you should stop smoking. Anything which is about good behavior adoption is not a good conversation you want to have. And this is the same with the board and risk management. It's good to know that you tick the boxes. You know, I have a very good chief risk officer. He's really good. And I have this wonderful top risk assessment table. And I have this criticality of risk. You know, Yanis used to be in group risk at, so he knows that better than me. But, you know, you have frequency and severity of, I mean, you have wonderful scenario making and so forth. The problem is, what do you do about it? And to have this influence internally to make bold action, you know, crossing out this supplier, you know, diversifying your currency risk, making sure that you work, you know, with this contingency plan in place. This is the tough role, is how do you go from being the diagnostic master to influencing the way you do, even if it is at a loss for turnover in the short run. And for me, that's going to be the big difficulty for risk managers in the next couple of years. But I'm sure Yanis may also have a few more insights, having been a risk manager himself.
Yes, and you see me smiling because you say exactly the right thing. I think risk management needs to step away from the models and the mathematical representation of reality. And not because models aren't good. And there's a huge things that are going to come to our benefit through computing power, data availability, and so forth, particularly in terms of real-time understanding of risks. One great example, and I'm sure Ludovic knows more about this, is real-time economics. For example, where patterns are identified either in transactions or energy consumption and so forth, and they give a much faster signal about what is happening in reality than national statistics and official, let's say, statistical publications can give you. And this is a great thing. At the same time, if this is not married with an understanding, just like the discussion we had today with the top-down main drivers of what is it that we should be worried about? What is it that can tip the scale to our favor or disfavor? And really deep understanding of the scenarios. All the mathematics in the world and analytics is not going to help. And I think pandemics is a great example. I've been guilty in participating in discussion on pandemics where there were discussions about probably at most the first or second order effects. And then when you did analysis about where certain scenarios would hit, you were finding that they would hit in areas where there was not that much insurance exposure. But what hit us in COVID-19? In COVID-19 hit us supply chain disruption, the complete interruption of transport, travel, and all those things, and basically the economy ground to a halt. So we learned now the tough way that we are as strong as the weakest members of our world community. We cannot ignore them. And just because they may not have an insurance policy to wave at us, it doesn't mean that we're not at risk of a event like this. And I think it also highlights the morality associated with all of this, because clearly as a society we should not be ignoring pandemics, regardless of how the first order cost of such an event might be allocated. We have to be thinking about this. And the same about some other, I think the pandemic should in general open up our eyes to other risks in the similar space, diseases that had been wiped out and are coming back, bacterial resistance and things like this, but this is a whole different topic. And by no means do I want to pretend to be the expert on this. So yeah, risk management, I think, has to change the way it interacts. And I think we need to study scenarios more deeply, understand them, and then indeed put the mechanisms at the right levels in place to enforce action, because short-term gain for long-term loss clearly isn't a sensible strategy.
Thank you very much. And now, as we have been talking on this topic over 30 minutes, and I am sure that our speakers have other meetings, I will excuse ourselves for not answering the left questions because they're coming over and over again. So I have written them down, and we can pass them over, so you can get the answers to them. Thank you very much for this great presentation and this great discussion afterwards. I hope that it was interesting for the participants as it was interesting for me. The recording, we have the recording. If somebody else wants to watch the webinar again, maybe we can send afterwards the presentation if we are allowed to the participants. So thank you very much again, and wish you all a pleasant day.
Thank
It was
you.
a pleasure to participate.
Thank
Bye,
you.
everyone.
Bye.
Bye. Have a good day, everybody. And Merry
Absolutely.
Christmas.